Hello guys, welcome to Beginner's Guide to Candlestick Charting. Right, so I'll just give it about 1 to 2 more minutes for more people to stream in before we get the session started. And if you guys have any questions as well, please put them under the questions chat. So for today, we will be covering Beginner's Trading Series. So for this, we will take a look at the anatomy of candlesticks, as well as how we can combine them with graphical levels in our analysis. Okay, so let's get the session started, right? So for those of you guys who are here with us, a very warm welcome. So just a quick introduction of myself. I'm Lee Sing. I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalists for the best FX research. If you guys are with us right now and you're watching this live, right, feel free to put your questions under the questions chat. If not, if you're watching a recording of this, feel free to reach out to me on LinkedIn as well with regards to the questions that you have. So just a quick disclaimer before we get the session started, the information presented here, it's not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today. We will first go and understand anatomy of candlesticks. We'll then move on to the strength as well as limitations of candlestick charting. And finally, we will cover doji as well as engulfing candles, right? Just to take a look at a few examples and how they translate to buying and selling pressure and what we can interpret from there. And then finally, we will move on to candlestick confirmations in terms of how we can combine them with graphical levels. So it can be support resistance levels, as well as looking at how we can use support resistance levels in our analysis. So we will first start with the anatomy of candlesticks, right? So this example that we see here, you can see that it's a bullish candlestick. So in general, bullish candlesticks are represented either in white or green here, right? Of course, you can customize the color as well. What's key to note on this is that you can see that the wicks of these candles would represent the high as well as low prices, whereas the shadow, which is also the wicks, right? So this will record the high and low prices. And the bullish candlestick pattern, the open price, which is this area, so this is the open price and this is the close price. You can see that for both cases, right, these are the same thing, just with different colors. But the idea is that the open price would be lower than the close price. So because it's a bullish candlestick pattern, right, prices would close much higher as compared to where it started. So this is what people often refer to as the OHLC values as well. O just means open, right? H means high, L means low, and C means close. So if you hover your mouse around, for example, a trading view chart, right, you can see the OHLC values of each candles. So this is for bullish candlestick. We have it for bearish candlesticks as well. So this is an example of a bearish candlestick. You can see here, right? So usually bearish candlestick patterns are represented either in black or in red. So over here, you can see that this is an example of a bearish candlestick pattern. So we have the high again and low. They are marked out by the shadows. So the shadows will mark out the high and low prices. Whereas in a bearish candlestick, you have open price being higher than the close price. So basically price would close lower. What this also shows you is that you have sellers coming in, right? And they manage to hold prices and push prices much lower than when it first started. So again, right, the images that you see over here, the one on the right and left, they are the same ones, just in different colors. So next, we want to look at the strengths as well as the limitations of candlestick charting. So for one, candlestick can help us to track supply-demand areas. So for this, we saw how the concepts are applied in our live analysis session. So the idea is that when demand fails, it creates supply and vice versa. So we will take a look at a few examples on how we can apply this concept in the next few slides. What we can also see from this is that candlestick patterns themselves can show us the buying and selling pressure. Of course, you don't want to trade it in isolation. So the idea is not to look at any bearish candlestick pattern and taking sells from just the signals alone. But what you can see from here, especially in the FX markets where we don't have volume, right? There's no centralized volume. What it shows here is that the body of this candlestick patterns can give us a clue as to the strength of this buying and selling pressure that we're seeing. So in general, if you see a huge candlestick pattern with small wicks and large body, this usually represents strong buying or selling pressure depending on the color of the candle. If your open price is lower than your close price, this is a bullish candlestick pattern. So you can see that you have buyers basically within that specific time frame coming in. It pushed prices much higher and they're able to hold the close price near the high, for example. Okay, so this is a bullish candlestick pattern. Likewise, for bearish candlestick, it's the same idea. So examples of this would include, right, candlestick patterns that could give us an insight into the buying and selling pressure will be your engulfing candles. So essentially engulfing candles, the idea is that you have one candle that's within the next candle. So this candle fully covers the previous candle. So we'll again take a look at examples of engulfing candles in a moment. Other examples would be your indecision candlestick pattern. So this would be a doji. Dojis are generally candlesticks with very small bodies as well as very long wicks. What this represents is uncertainty because your open and close prices are relatively near one another as compared to, let's say, your engulfing candles. The limitation of the candlestick charting, or rather charting with candlesticks, is that it doesn't show us the big picture. So for this, we will again have to look at it from the higher time frame. But the idea is that just taking a look at a chart from a specific time frame, it doesn't show you two things. It doesn't show you, one, how prices move within that specific time frame. So let's say if you're taking a look at the daily chart, over here, the daily candlestick pattern, you can see that we see that within the day itself, if this is a bullish candlestick pattern, what this shows us is that the high prices, it shows us the low prices. It also shows us that open price, it's lower, right? So price actually managed to go pushed up higher throughout the day. This it shows you, but what it doesn't show is that how price move within this specific period. So within a day, you can see that even though price opened higher, it could move up like this. It could also move up like that, right? So it doesn't show you how price move. So essentially, this is a limitation of the candlestick charting, right? For this, you will have to go down to a smaller time frame essentially to look at the movement in prices. That's one. The other thing it doesn't show is that it doesn't show us the bigger picture, right? So what we want to take note of is that when we are taking a look at this candlesticks in general, right? So bullish, bearish candlestick patterns, we won't be taking a full view of all the bullish and bearish candlestick patterns that we have, right? But the idea is to basically understand how we can combine or how we can understand and read candlestick charts, and also take a look at a few examples on what each candlestick chart represents. What each candlestick pattern represents. Okay, so in this example, you can see that the reason why we say it doesn't tell you the big picture is because if you are just trading it in isolation, right? So taking just one bullish candlestick and taking a long position from there, right? This bullish candlestick itself would not hold much if prices are in a downtrend. Again, right, how do we define a downtrend? It's when prices form consecutive lower lows and lower highs. You can see over here. So the idea is that the trend would continue on the downside, right? And the highs would hold, whereas the lows themselves would be taken out. So in a downtrend, when you see a bullish candlestick pattern being formed, it doesn't say much, right? Considering that the higher picture, we are showing bearish move. So in the previous slide, we covered on demand and supply zones interaction and how when demand fails, it creates supply region. So this is an example of to elaborate basically what we have covered in the supply demand zone concepts. So in this example, you can see that essentially demand area is one where we see price came into this region, tested it, right? We saw some kind of reaction over here. And another way you can consider this is that if you take a look at it in terms of market structure, you can see that this is the last high. And essentially this is what we can also call resistance area. Essentially price came and tested this area. So you can identify the last move, which in this case would be this move over here, and just take the extreme of this candle. So basically, right, anywhere within this zone, you can see that this is a strong recovery or a strong rejection. So what this represents over here is that you have buyers essentially coming in to push prices much higher. So this then creates a valid demand area. And when price came in to test this demand area, you can see that it reacted the first time over here with this bullish candles that we have before price eventually failed it over here. So once price fails this region, you can see that there are a few ways we can take a breakout confirmation. One, it's of course looking at just the wicks of the candles, or you can take a look at the close. So in this example, right, or rather just generally in terms of confirming breakouts, I would want to see a break and a close below this level, right, for it to be considered a convincing break. In this example alone, you can see that just the wicks alone, we see many spikes, right? But price failed to close below before it actually rallied higher. So the breakout confirmation comes over here where demand fails. You can see this region. So price broke below this region, again, the candle, right? So you can see this is the strong push up before that move down. So you can consider this candle as the candle that drove price to break the demand. So then it creates a supply region. What's interesting to note with this supply region is that you can see that following which, where the extreme of this moves serves as supply region, where price just came in, tap into the extreme of this candles or the supply zones. So price basically mitigate into the supply zones before it continued to the downside. What's interesting to note about this is that while you see supply zones being formed as well as this being respected here, what we want to note is that in terms of market structure, this is a key point to note. It's basically when price forms a low over here and it continues to the upside, you can see that if we want to trade in the direction of the trend, what we need to wait for is a clear change in market structure, which we are seeing with this demand failure. The reason why it's important to note the changes in market structure is because market structure reflects what we see on the higher time frame. So this is a bullish market structure as long as price continues forming higher lows and higher highs. And the assumption is that this bullish trend is going to hold until there is a change in structure. And for it to be considered a change in structure, we need the break of the last low that was being formed here, which is also the demand area in this example. Okay, so this is an example of how we can combine, or rather just looking at demand and supply zones, as well as how looking at how price interact within this zone and what we can derive from there. This is another example of how demand failing and supply failing, creating again demand zone. So you see the interchange in hands between demand and supply. So this area here, you can see again, this is the extreme of this move where we saw that sharp rejection. So this creates a valid demand area. Price came in, tested the demand area before the failure. You can see in terms of the movement, again, a sharp push down before the drop. So then it creates a supply. Price came into the supply region. You can see this region over here, right? So when you're in this area, we have basically this price oscillating between supply and demand, this area here. So essentially, this region would not have much confirmation. You can see price basically sitting on the supply region and then coming into the demand areas as well. So the confirmation comes when supply fails. You can see that this move over here, right? Price essentially broke above this. There is also a change in market structure noted here. How so? You can see that in terms of the lows, right? So this is the last high that was being formed. Again, if price were to continue on the downside, it should continue to form new lower lows. But in this example, you can see that the high was taken out and supply failed essentially. And again, when supply failed, it creates demand. So the candle, essentially the move that push and cause the change or the break in structure over here, it's this demand area. So you can see then price came in, started respecting this demand area before it continued much higher. So this is an example that we saw on CAD Yen here, right? So you can actually review the chart and see how this works. So price continued pushing much higher. So now that we have covered on supply demand zones interaction, I want to talk or cover a little bit more on uncertainty, right? So this would be one of the strengths or limitations of candlestick charting. So just now we covered on doji as well as engulfing candles. So in this example over here, I would like to highlight that this is an example of a doji. So basically, doji represents areas of uncertainty. What this also shows you, if you're to look at it purely from just a candlestick perspective, you can see that this is a bullish doji, which means that the open price, it's lower than the close price. And this is a bearish doji, which means that your open price, it's higher than the close price. What is interesting to note about this is that you can see in general, when you have a doji pattern, the open and close prices are relatively near one another as compared to, let's say, an engulfing candle pattern. So in this case, what it shows you is that there's a lot of uncertainty because buyers and sellers cannot decide, right, a winning side. So essentially what this shows is that you have prices forming relatively near, closing relatively near one another with long wicks. So this is an example of a doji, and what this represents, it's an area of uncertainty. You can see it especially when prices come near key levels, key support resistance levels. So dojis are generally characterized with long shadows and small bodies. We explained the part on basically how open and close prices are relatively near one another, which shows that you don't have a clear winning side in terms of whether buyers are gaining strength or sellers are gaining strength. Hence the small body, which also means that the open and close prices are relatively near. So there's little change in open and close prices. The next example we want to look at, so this it's on a different end, right? So this is an example of a bullish engulfing candle. If it's bearish engulfing, then it's the opposite. But the idea is that you have a candle that is lying within the candle, right? So the candle that we have over here fully covers its previous candle. So hence the name as it suggests, right? It engulfs the previous candle. So what this shows you in a bullish engulfing, right, candle pattern, it shows that buyers are in control. So you have this hesitation before we saw the strong push up. And generally engulfing candles, bullish or bearish, they're characterized with a strong body, right, or one with a huge body and small wicks. What this shows you is that there is sustained buying pressure, right? So it's not just a sharp push up and then this reversal after, right? So this one, usually you would see strong shadows or long shadows, right? Long spikes, signaling that it's just a sudden move up, but prices are not able to hold at this specific level. So in the bullish engulfing candle, it's different. You can see that this is the open price and this is a close price. What this shows you is that you have enough buyers or enough buying momentum essentially to push prices much higher and hold price within near its high. So in this example, you can see that this is a bullish candlestick pattern and it's a bullish signal. What I would like to highlight though is that while this candles itself give us insights as to how the momentum and price, what we want to understand from this is that we do not want to trade it solely in isolation. So if you have to load any candlestick patterns, right, you cannot be going on to a case where you're just loading any trading view chart, looking at bullish engulfing candles and just buying it up. This is important, right? Because again, you need to take a look at market structure and the overall trend first. If the higher time frame is in a downtrend, this bullish engulfing candle in a downtrend doesn't say much. So it's always important to note that these candles that we see over here, right? If you take a look at the charts, you can see all sorts of candlestick patterns. So it's important to note that these candlestick patterns have to be combined with the higher time frame, right? You have to look at the bigger picture. If you're in a strong uptrend, then this bullish engulfing candle coupled with a break above the resistance area, right? So if you have a clear resistance area that prices are coming into and prices are forming your higher lows and higher highs, this bullish engulfing candle can confirm the breakout of the resistance. And more importantly, it's in line with the uptrend, right? Because prices, the highs themselves are weak and these highs are constantly being taken out. So what we also can expect is that resistance areas are constantly being run. So this is important, right, to note that we combine these patterns, not trade them in isolation, but rather look at them with what the market offers on the higher time frame. So now that we have covered the candlestick patterns, right, next we will be looking at how we can look at candlestick confirmations combined with graphical levels. So this itself is not a trading strategy, but rather I'll be exploring different ways we can combine graphical levels as well as looking at candlestick confirmations. One of them will be dealing with supply demand areas, right? So this is the one that it's looking at price action. The other one would be looking at specific break or change in market structure. So we'll take a look at these examples, right? So these are actual charts that are taken from TradingView. So you can see this, right? The most common example, right? So I'll be using support levels in these few examples that we have moving forward. But you can see here, right, it works with support resistance levels. So the first thing we want to do is first highlight the key levels. So in terms of key levels, right, you might ask what would we consider a key level? So to consider a key level, take a look at any chart, right? The easiest way to look at it is take a look at it at a glance and see if there are any horizontal levels that very clearly divides the chart. So it can be levels like this, where you can see very strong and significant reaction of these levels. Like in this example here, you can see significant reaction of this blue zone that we've highlighted. Or even something like that, where basically price tested and reacted as both support resistance levels. What we want to highlight in this case is that when you look at these levels, make sure that the swings are significant. So what you want to see, it's basically a sharp rejection of these levels, enough buyers to show that there is this huge V shape coming into a support level. So what we don't want to see is ideally something like this, where price just comes in with a small bounce before it actually hovers sideways. So as much as possible, we want to see this sharp rejection here. Right, so this would constitute a key level. Same thing for resistance, right? So in this case, I've penned out this move. You can see that if you have to draw it in line chart, essentially this is how prices are reacting here, right? So this would be the support area. Don't worry too much about highlighting a specific level or specific zone, right? So the idea is that you can take it. Usually I'll just take the last candle over here. What this shows us is that it gives us a zone to work with, especially on the higher time frame. What you can also interpret from this is that when price comes into this level over here, right, when price comes into, let's say, a support area, in order to ensure that the support area would hold, right, we want price to come into this area on the higher time frame and then see that reversal on the smaller time frame, which is why don't fret too much about highlighting a specific level, because it doesn't matter, right? Not on the higher time frame. Go down to the highlight the zone so that you give yourself an area to work with when you're on the smaller time frame. So this is on graphical levels. So again, right, on this support area itself, you can see that you have a lot of buyers coming into the market to push prices higher, denoted by all this sharp rejection on this area. There is also a concentration of demand, right? You see buy orders basically lying here. You can also see this hunt, right, or the sharp spike that dipped slightly below the support area. The idea is that it could trigger into sell orders, right? So essentially buyers, when they want to buy with large volume, they need to meet an equal number of sellers who are willing to sell them at a specific price, right? So that they don't drive prices much higher before getting into the market. So essentially this is an area of liquidity, and it makes sense because if you think of it, right, from a support or graphical level perspective, if there's a strong support level where we saw multiple rejection, whenever price comes into an area, right, if you're trading just pure support resistance levels, what happened is that coming into this region, it will usually entice buyers to enter the market, putting their stop losses slightly below this level, on the idea that if this support level breaks, then they will want to get out of the position, right? So if they have buy orders here, essentially their stop orders or their stop losses are sell orders. So if you have a big player coming into the market and wanting to buy these areas, they need to find these areas where you have enough sellers who are willing to sell to them at a specific price so that they don't end up driving prices much higher when they buy with a big volume before they actually get into the position. So just something else to note, right? So there are a few terms for it, right? Some people call them order block, stop hunt, but the idea is that basically there is a candle that taps into a range of into an area of liquidity, right? So essentially to be met with more orders, so that if they are going to buy, they need to look for enough sellers at a specific price who are willing to sell them with big volume, right? So you can consider them an area where you have a lot of sell orders that are lying around. Okay, so the next example that I want to see here, we want to take a look at would be on, again, it's the same example on support where you see significant swings and rejections of these levels. So focus on this portion of the chart where you can see this area here. So essentially what happens is that price comes in, taps it the first time, right? And then saw the break in market structure continue much higher. We wouldn't have caught this move, right? Because this is on hindsight, but you can see that coming into this region, you have the reaction of this area again once, and then over here. So when price comes into this region, there are a few things that you can keep in mind. So one is, of course, right, taking this entry based off this area and then putting the stop losses just slightly below the key area that we have over here. Another way is to wait for confirmation on the smaller time frame. So if we are on the 1 hour, you can go down to the 5 minutes, wait for a change in structure. That's one, right? And if you don't want to go down to the smaller time frame, what you can also do is to wait for a change or a failure of the supply zone within this area. So just take a look at this portion of the chart itself. You can see that price tap into a demand area over here, represented by this wick that we have here, and then again over here. So what you want to do is again highlight the nearest supply area that we have, on the idea that if price taps into a demand area and the supply region starts failing, you can see the supply region above starts failing. What this tells you is that demand is now in control, right? And I can target the higher levels up here. So you can see that this is the move up, right? And this high itself failed to take out the low. You can see here in terms of market structure, this is the last high and this is the low. So what this shows me is that if demand starts gaining control over here, right, this high itself. It fails to take out the low, so this high could be a target. And then again, this high is the nearest high. You can see again, it fails to form a new lower low. So this high is also a target. Okay, so this would combine the concept of strong lows, weak lows, strong highs, and weak highs. So the idea is that if you're in a downtrend, right, or in this case, if you're in an uptrend, then the highs themselves will be the weak highs. They are constantly taken out because it fails to form a new market structure, right? It fails to break the low. So this is, So this is on graphical levels. Right, and this is another example. So in the previous example, we look at supply zones. So specifically, I want to highlight this area here, as we've mentioned over here, right? You can see the supply area. So again, the candle that held within this wick before that failure. So this is one supply area, and you can see it again over here, right? This is another supply area. So what we see over here is that you can see price coming in, respecting this zones, and then pushed higher. And then again, the same thing here, respecting this area. Let me just remove this. You can see the supply region, price coming in. We saw that slight decline before it continues up much higher. So this has supply zones. You can see how prices interact with this region. Again, then we want to bring in the concept where we covered earlier. When supply fails, it creates demand. You can see over here, right? So price came in, acknowledges the first supply zone. You can see this is represented by this bearish candle here. So once price pushes up higher, it fails the supply region, it then creates a demand area. And you can see that this bearish candle is now the demand area. So if I have to extend it across, you can see essentially price coming in, respecting the demand area before it continues higher. So what this also shows you is that when there is a change in trend, right, and it shows you that this high itself failed to put in a new low, you see that demand areas start gaining control over here, and you see it clearly where supply regions fail, right? But this failure itself is not enough to send prices much lower. It's just enough to see that slight reaction, which then creates a demand and continues to the upside. So this is another example. So in the previous example, we talked about supply regions. In this example, I want to look at market structure. So what we have over here is that you can see again, right, this is a resistance and support area. So noted by this line chart, where essentially price came in, we saw significant reaction of this before a clear break and close above. So this breakout confirmation comes with a break and close above. In this example, you can see significant reaction and a clear break above it, a break and close above this region. So what it shows us is that we now have a resistance and support area where price broke above it. It now comes in as a support area. And then the test before it continues to the upside. So this is how it looks like in terms of the line chart, this example. But again, when price comes into this area, how do we know for sure that this demand area or the support region it's going to hold, right? We wouldn't know because price could always continue much lower, right? It could continue to this area. It's also support area here. So the idea behind this is that when price comes into this region, we want to wait for either, right, as we've mentioned in the previous slide, a break or supply to fail. Another way is to wait for a change in market structure. So you can see that coming into this region, into this support area, right, you have essentially lower lows and lower highs being formed. You can see the structure, right? If I were to paint out the moves, you can see the highs and lows being formed, right? In this case, you can see that price broke above this region, but this move itself, right? This move over here, the one where price pushed up, it did not come from any key area. It didn't come from a key support area, right? So the prices are just hovering about. It probably came into a demand area over here. But the idea is that when price taps in, you can see that it taps into this key area, and this was a key area because of a significant reaction here and here. I would not consider this a key area because this is a small reaction. You can see that the pullback within this zone itself is relatively much smaller compared to something like that. You can see that if I were to just paint out the move, right, this is a sharp rejection. So when price comes into this area, what we want to wait for, it's again change in structure. So this is the last high that drove prices into this area. So in order for price to, in order for support region to hold, right, we need price to break above this high because this is the high that drove prices lower, right? So once price breaks above this high, what this tells us is that prices fail to form lower lows, right? And there's a change in this recent move because this recent move, if you go down to the smaller time frame, it's showing you a downtrend, right? Coming into this blue zone, blue demand or support area that we have here. So in order to consider this, in order to ensure that the support area would hold, you can wait for a break in market structure, a break of the last high, because what this shows you then is that there is a change in trend because this downtrend no longer holds, because if a downtrend holds, this high should hold, right? It should not be taken out. So the change in market structure comes over here where price broke above the high. It broke above this high, as you can see, and then pulled back. So it came into a demand area. So again, right, we can see this is the first sign that demand is holding. before it continued to the upside. So this is one. So the first clue is basically the break in market structure, which you see over here, right? And this break in market structure, right? So we're not going to go on to any chart and just find random changes in market structure. Remember, it has to come from somewhere. In this area, right, what causes that change in market structure? It's because prices are reacting or sitting on a key support area. Okay, so you cannot have a case where you're just loading a random chart and just highlighting a random area with no specific swings, right, and just looking at change in market structure there. Okay, so yeah, this is one area to consider. You can see the break in market structure, so the confirmation really comes in over here, and then price coming into the demand area again before it continued to the upside. Okay, so with that, we have come to the end of the session, right? I see that we have no questions as well. So I'll just run through a brief summary of what we have covered so far. So we started the session with anatomy of candlestick patterns, looking at open, high, low, close prices. We also shared how to basically read candlestick patterns, right? What do the open, high, low, close prices, how do the candlesticks reflect the open, high, low, close prices? Next, we look at the strengths as well as limitations of candlestick charting. For this, we went on to cover supply-demand areas, right? Understanding the concept that the interaction between demand and supply, when supply fails, it creates demand and vice versa. We also highlighted the need to look at the big picture, right? So not just trading based on one specific candle, right? Not a bullish candlestick pattern and trading it purely off that, but rather looking at the big picture, understanding market structure, and also what the higher time frame entails. We also covered on buying and selling pressure, right? How do we determine buying and selling pressure from candlestick patterns? For this, we take a look at two contrasting examples on engulfing candles as well as doji, right? So you can see the engulfing candles in general, their long body represents strong buying or selling pressure, whereas doji itself represents uncertainty because the open and close price are relatively close. And then finally, right, we took a look at the candlestick confirmations and how we can combine these examples with graphical levels. We look at it based on two perspectives, right? So looking at support levels, price entering into this zone. One is looking at the change in market structure, right, as confirmation. The other is looking at failures of supply regions. Okay, so this is a summary of what we've covered so far. Right, so with that, we've come to the end of the session. For tomorrow, we will be doing a live analysis session as well, right? So you can come in and get to ask questions on specific charts. We'll also do a review of any setups, right? So we'll be taking a look at what we have covered on Wednesday and if there are any setups for us to review. Okay, so with that, we've come to the end of the session, right? Thanks everyone for staying with us till the end, right? So take care, stay safe, trade safe, and we'll catch you guys again tomorrow.